Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
As traders look for clarity on the path ahead for rate cuts, the team at Morgan Stanley writed the following. We maintain our call for an additional 25 basis point cut in December. But the key question is what the data the Fed will actually have before December. A prolonged shutdown is a risk to our view of more consecutive cuts. Mike Gapen of Matt Hornbach of Morgan Stanley join us now for more. Gents, good to see you both.
Good
Thanks
morning.
for being here.
Good morning.
Mike, I'm going to come to you first. The data, we don't have much right now.
Nope.
This government shutdown, it makes it less likely we get rate cuts in December. Is that right?
Well, I think we're just reflecting what Powell said, that if you're driving a car in the fog, you should slow down. So he was saying there is a case to be made where if you don't have the data, maybe you can't act. My view would be that if we're still in December and the shutdown's in play and we don't have the data, I'd be really surprised if the Fed doesn't cut. I think the drag from a government shutdown at that point could mean growth is essentially zero in the quarter. And I would be surprised if there weren't some spillovers in the limited data that we see. So I think if we don't have data, it's because the government shut down, and I think that probably still justifies a cut.
We'll get to Matt in just one second, but Michael, from the economic perspective, do you get the sense that this is an economy that needs rate cuts, especially given the fact that the slow growth, slow hire, low fire kind of churn has been going on for quite a while and may have a lot to do with other factors outside of just the trajectory of the U.S. economy?
Well, so we came into the year thinking, no, you probably don't need to cut rates this year, that you would want to ensure that any inflation rise from tariffs is transitory, and then we thought the rate cuts would come in 2026. So, my view is maybe we don't need it. There's certainly a discrepancy between the data and a tension between the activity and the labor market data, but I'm not on the committee. I don't get to make the choice. The view is the balance of risk shifted and policy needs to be recalibrated. So they've made that decision. They want to move closer to neutral, and I'm just thinking the data will justify another step in that direction in December.
Matt, are you already seeing that with respect to how the bond market is responding to recent weakness and this idea that it seems as though everyone's buying the transitory story again? They're just not saying the T word.
Well, it feels to me as if the market had to adjust its pricing for the December meeting based on what we got out of the meeting last week. But the market is also at the same time hesitant of completely taking the December meeting off of the table because I think investors are starting to look at the bigger picture. They're saying, hey, 2026 might be a better year, but we have to get through the end of 2025 first. And the government shutdown is starting to slowly creep into the mindset of investors. And they're thinking, gosh, if the data do come in on the weaker side going into the December meeting, then the Fed should very well continue its gradual move back to a neutral stance.
Day 36, longest in history. The president is now talking to Senate Republicans, saying they should just blow up the filibuster in order to do this. Is there a line in the sand where the government shutdown would need to end for you to really think that December's back on the table because all that data will start flowing through again?
Well, I think to the point that Mike made, they're going to get some data. Even if the government does stay shut down for the next couple of weeks, we might not get as much official government data as we would like to get, but we will still get a set of economic data like the data that we got this morning. We'll get another round there, and we're going to get, of course, the state unemployment claims data as well. So they're going to have something to work with. And so, to us, it's going to be the totality of whatever they have in hand that will lead them to decide what to do in December.
Mike Gapen, we've got the earnings. That's what we can go on. And we can talk to corporate executives. And we've spoken to a few already this morning. One bank executive came on the program and said things are okay, better than okay. There's no real damage in our loan book. And we expect re-acceleration into the new year. This runs counter to the view that you have on the labor market. Can you just flesh out what you do expect to see in the labor market in the months to come?
Yeah, so there's certainly a tension in the data. The activity data is solid. AI-related spending, off the charts. Upper income households doing well. You were emphasizing that in the previous segment. but the labor market data looks different. So our view is we're maybe a third of the way through the process of firms passing tariffs onto the consumer. So that's going to extend at least into the first quarter of next year. While that's happening, I think there'll be great reluctance to hire. We've seen that. The low hire, low fire labor market, the ADP report's very consistent with that. So while that's going on, we think the unemployment rate creeps higher. And we have the federal workers who took the early retirement package who will be rolling off payrolls in October to the tune of about 150,000. So we think the unemployment rate could finish this year, around 4.5, 4.6. And if that's, it's not a meaningfully higher move, that's still a very low unemployment rate, but the direction of that move, I think, is enough for a Fed chair who says he's now a little more data dependent to say, let's take another step. So modest deterioration, modest continued cooling is what we think that message will be out of the labor market.
Forgive me for referencing your old colleagues. I want to talk about Bank of America just a little bit. I want to talk about what Brian Moynihan's going to be discussing later on this morning. He's talking about less labor-intensive revenue growth. And I wonder if we need to focus on less labor-intensive GDP growth. Mm-hmm. And I just wonder what that means for the Federal Reserve. And I'm going to get to what it means for the bond market too, because I don't know if fixed income should trade on the jobs numbers or GDP. What's it going to mean for the Federal Reserve in the quarters to come?
Well, this is also part of the fog story. This rolling in is a difficult thing to understand and manage in real time. I'm not sure in the short run it changes their thinking all that much. It'll have an implication on the labor market. If it's a supply side productivity driven story, it'll also be something that brings inflation down. Right, so that it would reinforce I'll use the T word, the transitory inflation story. It would reinforce that. I think it would give you more confidence that inflation should be coming back down. And if anything, it would leave this kind of low dynamic labor market in place. I think both of those would say the Fed will have a gradual easing bias.
This has market consequences, of course.
Yes.
If you look at payrolls, there should be some kind of loose relationship between what happens with jobs and what happens with earnings. But this year, at least, we've managed to have a massive step down in jobs growth, and earnings growth has been absolutely fantastic. So equity land can ignore what happens with jobs. Can the bond market? What should the bond market trade on, jobs or GDP?
Well, the bond market typically trades on the Fed. So if the Fed is going to continue to lower its policy rate, then you would expect the bond market to trade in kind. Now, we all know that the bond market is priced for a very gradual easing of policy. The issue, though, is if the Fed delivers on what the market forwards are telling you today about the path of Fed policy, it's not as if the market forwards are just going to sit there and shrug their shoulders. They're going to move. And that's the typical behavior in the bond market. When the Fed follows the forwards don't just sit there. They keep moving in that same direction. So from our vantage point, if the Fed delivers an easing cycle in line with what Mike believes and in line with close to what the market forwards are pricing, the forwards are going to keep moving, and that's going to continue to weigh on bond yields. Already we have a 10-year yield right around 4%. We're the only house on the street that thought that would happen this year. So as the Fed continues to deliver, we do think that bond yields will continue to fall.
At what point are you starting to get more concerned about longer-term inflation and a longer-term pushback in U.S. Treasuries? I'm looking right now, Mike pointed out, Michael McKee, parsing through the auction refunding announcement, pointing out that they do plan to increase their T-bills and their low-duration instruments. And there's this feeling that the Fed's going to monetize that. The Fed's going to increasingly buy that debt, call it whatever you will, in order to keep rates low while also pegging rates to a fairly low level. At what point does that pose a risk to longer-term treasuries and the potential for this to backfire in terms of some investor appetite?
Yeah, I think you're talking about the bond vigilantes that show up every now and again and typically lose money at the end of the day. From my vantage point, we're going to have to see it in the data. Okay, if the Fed is lowering interest rates and inflation is moving higher, that would be the type of environment that I think would get bond investors very, very nervous. We're not really seeing that, right? We're seeing a committee that is divided on what to do in this inflationary environment. But if the inflationary environment turns out as we're forecasting, people should be very relaxed about owning high quality duration in the bond market. And by the way, just on the Treasury refunding that happened this morning, that's very much in line with our projections, not just for this refunding, but for the next several refundings. We don't believe that the U.S. Treasury is going to increase their coupon issuance until February of 2027. I mean, for all intents and purposes, that's a lifetime away, and a lot of things will happen between now and then. So we don't really see an issuance problem for the investor base and for the bond market.
Mike, I'm just wondering, what's the Fed's mandate right now? Because if the mandate is low unemployment, then right now you could make an argument that maybe it is a positive thing for them to ease. But if it's for financial stability and the idea of inflation, asset price inflation will at some point trickle into the real economy, especially in AI and energy costs and some of these other kinds of issues. How do you square whether they're potentially adding fuel to the fire?
Well, and they're risking that, right? They are taking out insurance right now against what they see as downside risk to employment. And insurance comes at a cost. And that cost is what you just mentioned, the risk of higher inflation over time, that you're a more inflation-tolerant Fed, or you fuel animal spirits in asset markets. But Powell has said many times, we do not have good choices right now. Right, so they think risks are higher to the unemployment rate, to the upside in inflation, and there are concerns about animal spirits in financial markets. So they're taking out insurance against the labor market. They're betting that the cost of that won't materialize, but that's what markets and investors are concerned about.
Matt, can we finish on the FX market? Bit of dollar strength's come back in the last 5 days. How does your medium-term view stack up with your short-term view on the US dollar?
Indeed, yeah. So we came into this year very bearish on the dollar. We held that view until last week. So given what we're seeing from the committee at this moment in time, in the absence of a full set of economic data, we decided to peel back on that view temporarily. It's a tactical adjustment in what we think will be a trend that extends into 2026. It doesn't have to play out that way. One of the things that we're debating as a House today alongside my colleagues in economics is, what does 2026 and 2027 look like? That can be a game changer for the US dollar. We're still debating that. But in the meantime, if the Fed continues to cut rates, the dollar should have a little bit more room to move lower before possibly swinging higher in the second half of next year.
Stay with us. More Bloomberg surveillance coming up after this.
Democratic Socialist Zohran Mamdani winning the New York City mayoral race with 50.4% of the vote. Kathryn Wylde, CEO of the Partnership for New York City, writing the following: ultimately, the impact of the election on business will depend on the extent to which Mamdani appoints competent deputies and commissioners to run city agencies. Kathryn joins us now for more. Kathryn, good morning.
Good morning.
Thank you for being here with us in New York City. Let's talk about some of this. What did New York just vote for?
Well, I think, number one, we have to look at the fact that more voters came out to vote for mayor than we've seen in the 56 years, since 1969, which was my first election in New York, when John Lindsay was elected on the liberal line, actually. So this was a big turnout, and I think it reflects the frustration of the New York City voters with a couple of things. Number one, the high cost of living and doing business in New York City, and which Zohran Mamdani spoke very effectively to. And it reflects a frustration with a series of politicians who have disappointed New Yorkers.
Those high marks in terms of how many people came out to vote was fueled by support of Mamdani, but also those that were against him. There's a lot in the business community that have a lot of concerns. Has he assuaged those concerns yet?
I cannot say that he has assuaged those concerns completely. After the primary election, when everybody was shocked that he beat Andrew Cuomo by 13 points in that primary in June, he reached out, actually called me right away and said, tell me which business leaders I should meet with to learn from them and to show them that I'm not going to socialize their businesses.
Who did you advise he meet with?
I gave him a long list of people. I mean, our co-chairs of the partnership, Rob Spire and Albert Bourla, and Jamie Dimon, obviously, Larry Fink, leaders from across the industry, as well as the small business representatives, the borough chambers of commerce, the Restaurant Hospitality Association, so a mix.
We have a lot of reporting that what business leaders wanted to see was him to tap Jessica Tisch to continue to lead the NYPD, be the commissioner there. Is it your understanding that she's going to stay?
Well, I think she's going to stay, and I will say that was the number one priority. It was an important signal both to the business community about the public safety. As employers, they want the city to be safe, and Jessie has done a great job. They just announced this week that crime is down again this month, another 6.5% on her watch. So that was a big ask, and the fact that her family is iconic in the city's Jewish community, I think, was also another important piece of that. Mamdani did say that he would retain her. I know they have spoken, and she was not going during the campaign. She was not going to make a commitment one way or the other because she doesn't think it's professional for her, in her job as police commissioner, to participate in campaigns. But I'm hopeful and optimistic that she will stay. She loves her job. She says her mission is not finished, so I'm very hopeful.
You've been in the city a long time, tracked its politics, and been a nexus between business and the political sphere. And I'm just wondering if you've seen real evidence of people leaving the city in fear of higher taxes or some sort of regime that makes it less desirable for them.
Well, people are leaving the city because of high costs in general, and taxes are part of that. And for those who think, and a big concern about our incoming mayor is that he may think that somehow spending more government money is going to make the city more affordable, when in fact it's exactly the opposite. City and state budget spending has gone up over 50% in the past decade, and that's driving our affordability crisis. So hopefully we will be successful in finding other ways to fund some of the new mayor's priorities.
Is there any evidence that that's on his docket? Because he talked about raising taxes on the wealthiest individuals. He talked about paying for it that way. Is there any sense that there is some sort of awareness of the debt and sort of the debt cycle that cities can get into that can make things less affordable?
Well, New York City has a legal debt limit, and we also, since the financial crisis of the 1970s, if the mayor gets too aggressive about his spending, a financial control board comes into place and the state takes over the city finances. So we don't have to worry about New York City going bankrupt again. So that's a check on that. In the conversations with him about the danger of raising taxes in terms of New York's competitiveness, I mean, right now, those of us professionals in New York are paying 55% of their income in taxes to federal, state, and city government. If you move to Florida or Texas, you're paying 38%. So that's a pretty big number that we have to take into consideration. So I think that he's going to become more practical as he sees the implications. He has said, I have my goals, I want to achieve them, but I'm wide open on how to do that. And that's an opening, I think, for business expertise to help him figure this out.
Well, to achieve them, he says he's going to raise taxes, but Governor Hochul says, I can't lose any more people to Palm Beach. To your point, looking at the tax differentials. So can he even attempt to raise taxes without the governor on board?
He cannot raise corporate or personal income taxes without, well, that's not a city prerogative. That is a state prerogative. He can raise real estate taxes, but he has said, as he's thought about the implications of freezing the rent, he has said he will actually do property tax reform and try and reduce taxes on rent-regulated commercial buildings, multifamily buildings. So I think that as we see who his appointments are and how he takes input on his appointments. Last night I was very pleased that the tax word was not mentioned in his acceptance speech as mayor, so that was a good sign. And he also started out how he's going to achieve his goals is we're going to reduce the cost of government and reduce bureaucracy. So he's sounding more and more like Mike Bloomberg.
Stay with us. More Bloomberg surveillance coming up after this. The US Supreme Court hearing arguments today challenging the legality of some of President Donald Trump's tariffs. If overturned, the government may face refunding billions of dollars in a blow to the nation's finances. Lisa, this in many ways is about the bond market more than anything else.
If you don't get the $400 billion of annual revenues that we seem to be on track for from the tariffs, what does that mean for the deficit picture for some of the bond vigilantes that have gone into hiding and are covering their heads? There is this feeling that they might reassert themselves and push back against some of the recent price action. Again, it's not going to be until the end of this year that we get a ruling, maybe the beginning of next year, and by then we might have a sense of what the cocktail of additional tariff measures might be to replace this income.
This is going to be tough for the Supreme Court. They're going to look at the U.S. Court of International Trade, and they said the U.S. Constitution makes it clear that this authority of commerce is up to Congress. And they go on to say it's not that we are not passing judgment on the wisdom or likely effectiveness of the president's policy, but just that it's not constitutional, which is why the administration is trying to make out that these are three big emergencies when it comes to fentanyl, the trade deficit, and having that ability to say, have a threat against China when it comes to rare earths, that they need this authority to be within the executive branch.
On the president's list of priorities this week, including what's happened in Virginia, New Jersey, and here in New York City, was this number one, this hearing at the Supreme Court? He's
called it life or death for the U.S. economy, and he said in that CBS 60 Minutes interview that the economy will go to hell, his words, if IEEPA does not withstand the Supreme Court. So for him, this is paramount. But you talk to people in the administration, there are other ways they can enact tariff policy. It's just not going to be as clean. It's not going to be as blunt of an instrument, but they could still use other orders like they are using right now. They're using 232s. They're 301s. There are other instruments they can use, but it's not as easy.
Let's stay on this story. Regardless of the Supreme Court ruling, the former Commerce Department official, Nazak Nikakhtar, expecting Trump's tariffs to live on, writing the administration has several other tools that they can implement to execute their trade agenda. Nazak joins us now for more. Welcome to the program. Let's just talk about that. What is actually at stake today if the president could just make other moves elsewhere to achieve the same means?
Well, I think and it's good to be with you. The big question is this International Emergency Economic Powers Act of 1977 that allows the president to regulate imports during peacetime and take measures to address unusual and extraordinary threats. The core question is really the limitations of the president's power. Does the president have vast sweeping authority to impose tariffs in a way, regulate sort of financial aspects of the United States, or is it Congress that holds the cards there and can only delegate financial revenue raising authority to the president when it expressly says so? Those are the main questions. The Supreme Court has never heard an IEEPA case before. It's never interpreted the language. So the main question is, does this law give the president sweeping authority to regulate imports through taxes, through tariffs, which are deemed to be taxes by the judges, or is the president's authority much more restrained?
Going into this, what is your base case for how the Supreme Court will rule?
You know, it's really difficult to say. This is a very, very difficult question. You've got the major questions doctrine, which is going to be at heart of this issue, which the Supreme Court has to decide. Look, constitutional interpretation. If Congress intended to give the president vast political authority over political and economic questions, does it need to expressly state so? Think about the impact of all the other statutes. How much can the executive branch read into this, right? And right now we have three pillars of the U.S. government that are at odds with one another. The president has moved in a very unusual way to read the statute very broadly. Congress, in large part, has remained silent, even though with respect to the tariffs on Brazil, Congress has spoken up and has used its lawmaking powers to restrain the president's authority there. And now you've got the judicial branch who has to make sense of it all. And again, implications are going to be significant with this much revenue at stake.
The administration has talked about why they're using IEEPA, emergency responses to the trade deficit, to what's going on in terms of China trying to enact export controls on rare earths and then on fentanyl. Do you think one out of any of those others have more of a case in terms of an emergency authority needed to combat those issues?
Yeah, that's a great question. And this really goes back to the sort of the history of IEEPA. IEEPA has traditionally been used over the decades as really sanctions authority, right? Maximum economic pressure campaign on countries to do and not do things. So it really depends on how the U.S. government argues it. The tariffs on India, these IEEPA tariffs on India, is a maximum pressure campaign because they're buying Russian energy. We have sanctions on Russia. The IEEPA tariffs used against India feel like sanctions. They might, for the fentanyl crisis, also feel like a maximum pressure sanctions type legal authority. But if the president just doesn't like a trade deficit with a country, can he use IEEPA? I think that the courts may very likely say there's different legal authority for that. If Congress gave the president distinct legal authority to address a specific fact pattern, then can he use other legal authorities that are a little bit vague to address that same fact pattern?
Nazak, from a market's perspective, it's important to ask how much has actually changed since pre-Liberation Day. You're looking at an overall tariff rate that's gone from 2.5% to about 12.5% versus the headline figure that's somewhere closer to 20%. And a lot of some of the measures with respect to China in particular have been walked back. How much have the walls truly been put up in a way that do indicate some sort of separation of the world's two biggest economies?
This is the economic impact, at least first to the United States, right? I think partially what the president is thinking he's doing is really balancing fair trade, but then getting trade deals to bring countries closer into the United States orbit, right? And maybe this relationship with China is still up in the air. But I really want to underscore the massive economic impact. We have about $90 billion collected in the IEEPA tariffs alone. Think about the economic impact of either way that the court rules. If the court invalidates IEEPA, you've got importers, U.S. importers in large part who are paying the tariffs, but they pass through those tariffs in some significant respects to their customers. So if the court invalidates IEEPA, you've got the importers getting this massive sudden windfall of money, but then their customers aren't getting anything, will present one major shock to the economy. And if the courts uphold IEEPA, then these importers are not going to get the money that they were expecting, yet another major shock to the economy. And going back, if the court does invalidate IEEPA, now you've got importers in line to not only recover the tariffs that they've paid, plus interest, because that's how this works. If you actually paid tariffs that the courts have invalidated, you're not only entitled to get the tariff revenue back, you have to get the tariff revenue back plus interest. Think about the sudden shock to the economy, depending on either way, based on how the Supreme Court rules.
What are you advising clients? Are they lining up and figuring out how exactly to request their money back from the government?
Yes and no. There's a lot of importers who are thinking about watching this very closely and figuring out how they're going to line up and what the process is, because you can't have a stampede all at once for all these importers, right? $90 billion trying to get the money back at the same time. So the courts are going to look for a process. We're looking very much into what kind of process is going to be set up for importers to get their revenue. But also we represent a lot of the businesses in the United States who've already paid those tariffs. And even if the importers of record get that revenue back, a lot of our clients, a lot of the businesses aren't going to get that revenue back because those go to the importers. And then that's a private transaction issue, whether the businesses are going to demand from their importers to get some of that back. Very unlikely, because then that becomes an accounting issue. But there's going to be a stampede, and hopefully the government figures out an orderly process only if the Supreme Court invalidates the tariff. But look, for the Supreme Court, is this a textual issue? Is this a constitutional issue? Is it a foreign policy issue? All of this is going to really weigh how the Supreme Court looks at this.
Stay with us. More Bloomberg surveillance coming up after this.
Apollo Global Management just posted third quarter earnings that surpassed Wall Street estimates as the firm edges closer to reaching $1 trillion of assets. The Apollo president, Jim Zelter, joins us now for more. Jim, good morning.
Good morning. Always good to be here.
Congratulations. We joked when you walked in. What happens when you hit $1 trillion? Does Mark run around popping champagne? How does this work?
Well, listen, as we said yesterday and we've said before, assets under management are just a great vote of confidence for great performance. And if you deliver for investors over time, we find ourselves the flywheel of our business is really in place, whether it was capital formation, whether it was origination. We just find that our business model is really hitting the mark right now and accelerating. And we're very happy with the quarter, but feel very good about the trajectory of the business in front of us.
There's a phrase that you and the team use, we are what we originate. Can we talk about that a little bit more?
Sure.
Your capacity to scale, can you just flesh that out, how things are tracking at the moment?
Well, they're tracking very well, but I think, if you go back to our Investor Day 6 years ago and a year ago, we really put a pin in the key attribute of success in our business. As we see the financing markets evolve, when we see the evolution of banking system, when we see the evolution of private capital, many in our industry, and we're guilty of it quite a bit. In fact, your first question, we're guilty of it. It's all about AUM. It's not about AUM. It's about your ability to really generate very strong, proprietary, scalable origination across the spectrum, whether it's investment-grade private credit or private equity transactions and everything in between. And we have taken that to heart. We've invested a tremendous amount of money in terms of our origination platforms. And I think that's what when investors come to us today on the institutional side, when sovereign funds come to us to partner, when insurance companies come to partner, yes, it's because of our investor returns, but it's because of our origination. And I just think that's the bigger story here. People want to talk about this company, that company, First Brands, Tricolor. It's been 16 years since the great GFC. The real story is the evolution of modern finance and the role that we all play. And so I think that's the thread and the theme that investors are really engaging in today. I just got back from 9 countries in 2.5 weeks, which I'm happy to talk about. And the impact around the globe of this model evolving is really the story.
We'll spend some time on that. Just for the record, you brought up First Brands and Tricolor before we did. We'll get to that in just a moment too. You want to talk about origination? Let's talk about it. Of the debt that you originated, you talked about this a bit yesterday. What was the average rating? And are you able to maintain excess spread as you scale up?
Yeah, so if you look at we think about the world investment grade and non-investment grade, not private and public. And when you think about the spreads that we garnered in terms of our investment grade business, it's in the mid 300s. And we've been able to really create that spread over the last 24 months with a little degradation of 15 to 20 basis points year over year. On the non-investment grade side, it's in the mid 400s. And again, we've been able to generate that spread over the last 24 months. And again, it's not just the direct private lending, but it's all the things you do to a sponsor. So our origination footprint is about 80% investment grade, 20% non-investment grade. But really, it's the change of the model in the last 20, 30 years as a credit investor or fixed income investor. You were an agent in the market. Whatever the origination machine wanted to deliver you, it was only price that you actually had to negotiate. And so you were an agent with really not a lot of the ability to really conduct and have the outcome. In our model, where we're the origination principal, where we actually have an impact, it allows you really to have a much greater degree of control of documentation and return and yield, and that's going to suit us well over time. So it's this principal agent issue, and we find ourselves really in the leading pack of the origination principal model versus the old model of an agent or vendor model.
And Jim, what this does is it allows you to look at a lot of documents. It allows you to look at a lot of companies. It allows you to see a broad swath of the economy, to understand exactly where the pitfalls may be. Do you find some of these arguments about cockroaches and in growing weakness in the economy credible, or are you just not seeing it in what you're reviewing, even among the things that you're rejecting?
You're 15, 16 years in a credit cycle right now in terms of the expansion since the GFC. you're going to find issues and challenges. In the last 5 to 7 years, you've had companies like SVB and First Republic Bank. And so, yes, these are clearly idiosyncratic. We're seeing a much larger theme of a strong economy. Torsten talked about it yesterday in terms of a K-shaped economy. We're seeing an administration that's very pro-business, not very regulatory friendly, want to push rates lower. And so all of those things, where you will see challenges in certain companies late in a cycle, but we are not seeing any kind of credit cycle on the horizon that's waning anytime soon. We are not seeing it.
Are you seeing a scary allocation of resources? And I say this given the fact that it has been very top-heavy to AI-related endeavors. Deutsche Bank this morning, a story in the Financial Times, looking for ways to hedge against some of their data center loans because they're worried about the overall concentration, the risk that you're seeing overnight. Yeah. Are you staying away from that?
Well, I think what you're talking about is whenever you see a massive infusion of capital into a sector, dark fiber, E&P shale in the U.S., software enterprises, and now AI in the broad ecosystem, you have to think about debt and equity returns on invested capital. And there's been a tremendous rise in valuations on the debt side, on the equity side in the last 24 months. And certainly the assumptions that you're making on the debt side as an investor and a lender to those companies, you're taking more residual risks than you did 6, 12, 18 months ago. So valuations are high. You have to be a bit more cautious. You want to be a lot more senior. You want to be secured. And so I think there's going to be a dispersion between returns between the investment grade and non-investment grade market. But that's just late cycle behavior. And when you look around the globe, as we talked about yesterday, their valuations are high, geopolitical risks are a bit greater, and we don't see rates dramatically lower in the next 24 months. So that tells us take the risk down on subordinated credit, lean into senior investment grade opportunities.
Jim, we've seen these capex cycles throughout economic history. You've lived a few of them over a long career as well. But there's something different about this one. And you're well versed in this in a way that I'm not. Some of these assets depreciate rapidly. For you and the team, does that change how you put together some of these deals that you make?
It does. I mean, I think you're raising a really interesting point. Are we thinking, is the right way to think about a data center, utility lines and electrical lines 70, 80, 90 years ago, when day one, all you were doing is wiring the house for lights, and then you wired the house for a dishwasher, a TV, and everything else that goes with it? And how do you think about that technology, and what really is the advantage of that data center in 5, 10, 15 years with the power supply? I differentiate that with how you might finance a portfolio of chips, GPUs, that rapidly depreciate over 3 to 5 years. And they might both be in technology, but how you fund and structure both of those is very, very different. And I think that's the subtlety behind the headlines, which is going to differentiate the winners and losers, because in every industry, even the last 20 years that I just mentioned, those are all sectors that drew in a tremendous amount of capital, and you really don't know who the winner is from the debt and equity side for a few years. And so certainly with valuations as high as they are in this cycle right now, you have to take a step back and pause and say, okay, do I want to be a lender? Do I want to be an equity owner? What's the residual value assumptions that I'm making? That's really what will differentiate the winners and losers.
I'm not sure how many people are taking a step back, Lisa, at the moment.
Right now, it seems like absolutely nobody. Those debt offerings are absolutely flooding. And frankly, there is a real question about whether there's behavior that potentially isn't as prudent as what you're doing that could potentially pose some sort of risk to the rest of the market.
Well, if you think about the Mag 7, in the last 5 to 7 years, they have been a very, very small participant of the IG new issue market. In the last 2 months, there's been a handful of these companies that have been issued very, very large benchmark transactions. And again, that's not a zip code we play in and day out, but you have to wonder, as a CFO, are they being very strategic about accessing that financing, and what's the long-term return of those opportunities?
Jamie Dimon at JP Morgan has said, we survived Bill de Blasio, we'll survive this. How do you and the team think about this development?
We're committed. I've been in New York 40 years. I'm a committed New Yorker. The campaign is over. Now it's about the action plan. And he needs to bring people together. He needs to get a leadership team that can take on the challenges of the most complicated city in America. And if you're a New Yorker, you want to see success in this administration. The campaign's over. All the great promises, now it's about delivering. It's like when you buy a company. It's not, you don't celebrate the day you buy it. You celebrate the day you sell it in 3 to 5 years. So I think there needs to be a change in tone, and he needs to bring the city together. That's the big objective. Bring the city together and bring the best and the brightest to City Hall to work with him.
Bill Ackman said, this is an individual who spent a lot of money trying to defeat him, said, let me know what I can do. So that's the approach it sounds like Apollo is taking. What would you advise him?
Well, I think number one, you've heard it. People think, public safety is the number one fiscal stimulus. And there's a lot of concerns about the campaign and what was said about public safety and the focus on that. So I would focus on bringing leadership together. I would focus on really making sure that the city is safe for all citizens, and then try to create a very logical engagement with all the constituents. That's day one.
That's day one. Let's talk about what's happening right now in this economy, which is what got Mamdani elected, affordability. You want to talk about the transmission of monetary policy as well. I think this is an important point. What can we do to support this economy and not exacerbate existing problems?
Torsten laid it out well yesterday. If he is right, which I believe he is, about the K economy in terms of the differentiation between those at the highest 20% and the bottom 20%, for the last 15, really since the GFC around the globe, and especially in the U.S., politicians have sort of stood back and wanted the monetary policy to solve all the problems. There's only so much that monetary policy can do. The fiscal impact of leadership, not only in the U.S., but in Western Europe. I was there last week. They really need to step up and have a plan about technology investment, employment, education, and a variety of attributes that are not really monetary policy impacts. So again, I think I'm not suggesting that we're not really focused on what the next move of the Fed are. They are critically important, but we are skeptical that even a lower impact and any kind of lower rates, it's really just going to fuel what's going on right now in the asset price frenzy, rather than having real impact on affordability and housing. Taking Fed funds down 25, 50 basis points, it doesn't solve your housing crisis. You have a national housing crisis with affordability. So I think there needs to be a massive pivot away from what monetary policy can do and how really executive leadership and fiscal policy will have a bigger impact.
Should and will are two different things. And right now it seems like the Fed is probably going to cut rates once more this year and then again several times next year, especially potentially with new leadership. Are you saying that you don't buy the argument that that's going to help the shoppers at Chipotle and the shoppers at Cava be able to afford their burritos and the Mediterranean salad bowls more efficiently, and that instead it's going to exacerbate the K and cause asset price inflation that leads to a potential threat to financial stability?
Yeah, I don't see. I got a couple of a 24 and a 29-year-old. Not suggesting that their consumer attributes are going to change by what the Fed does, but I just don't see how the Fed policy of this quarter or the next 2 quarters is going to have a real impact on the accentuation of the K economy. I just don't see it. I see it much, much broader. And again, I do think, getting back to New York City, we have a portion of the economy and a portion of the demographics that is very focused on education, jobs, employment, affordability. And I just think we got to think a much longer perspective here.
As an investor, if the Fed does cut, do you lean into the bubble? Do you say, all right, well, if you can't beat it, join it, and the idea is you've got to take more risk and get more returns? That's
not what we do. That's, there's folks who spend their day spending time about where the equity market's going this hour, this day, this week. That's just not what we do. We're much more focused on financing the global industrial renaissance, transactions we announced with Ørsted last week, or earlier this week, what we did in Europe with RWE. I was in Germany in the last 10 days. Massive global industrial capital needs. That's what we're focusing our time today. And that's what our investors want too. They want safe, robust, long duration yield. Whether the return on invested capital of XYZ data center in 15 years works, that's not what we do.
There was a headline yesterday on what you didn't do, and that was take Papa John's private. You probably don't want to talk about that directly, but can we talk about that broader business? Because Elisa mentioned Carver and what's happened with Chipotle. How tough is that business right now? How difficult are things?
I think as a principal investor in equity, in private equity and private capital, you need to think about long-term consumer trends and what's going to have an impact on various business models. And for us, we've had a real value discipline. Purchase price matters for the last 35 years. It's served us extremely well. And so, I think that you have to think about the evolution of consumer sentiment, consumer behavior, and what your impact is on different business models.
We've got about a minute left. Can we finish on what I believe is a PR battle between you and the banks at the moment? Not you directly. It just feels like everyone's trying to say the cockroaches are somewhere else. And I was listening to you yesterday. There was something that you said about it doesn't matter where the debt originates, the asset manager or the bank. Why is that such an important point?
Because I think we've collectively lost our way. We sit on top of this amazing economy, and what we have just found is the litmus test of quality is not public or private. We've sort of have collectively lost our way. The litmus test was how good the company is and how they will perform in their business model. And again, you've got great investors in credit, you've got great banks, you've got great insurance companies. There will be a dispersion of returns over a more challenging cycle. So we're committed to open architecture. We have amazing relationships and partnerships with many, many banks, some of which are public, many of which are private, and we're going to continue that, and it really helps us our origination. But I think the longer story that gets written will really be about credit quality and the sustainability of your business, rather than something as public-private. That's not the litmus test.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.